All right, we are live. Welcome, everyone. Give us a few minutes and we'll get live on all the platforms. Thank you for tuning in today. Good morning. Good morning. Thank you, everyone, for joining us. We'll get started here in just a few minutes. Today is February 17th. We are live. It's just after 11 a.m., so our programs now have live rates. So just give us a minute until we go live on all of the platforms, and we will get started. Thank you for joining us today. There we go. Looks like a bunch more people just tuned in. Thanks, everybody, for joining us. We are live now. There's some more people in the chat. Good morning, everybody. It is February 17th, just after 11 a.m., and we have live rates for all our programs. So we will get into the show in just a second. All right, looks like we are live everywhere. So thanks everybody for joining us. Let me take the chat off. If you have any questions on any of our programs that we're going through today, feel free to drop a comment either on YouTube or LinkedIn or wherever you're watching it, and we can try to answer those questions towards the end of the show. But let me go ahead and take that off for now, and we will get started. Thank you, everyone, for joining us today. My name is Nick Hiersche. I am the president of the Mortgage Calculator. We are a lender that specializes in non-QM and alternative income documentation, as well as your standard programs, conventional, FHA, USDA, and of course, VA, which is going to be our deep dive topic for today. So we're going to go into the live rates now that it is February 17th, just after 11 a.m. So all of our standard programs have live rates, which I'll do a quick demo here in a minute. And then we'll go into a deep dive on our VA loans with Jose Gonzalez, our sales manager with 27 years of experience. He'll talk a little bit about the ins and outs and the different ways we can structure a VA loan. And then we'll close it out with Kyle Hiersche, our COO, who will go over how to connect with our team to get a detailed quote. So let me go ahead and switch screens here and get into our live pricing for today. Just give me 1 second. Let me switch this up. And here is our live pricing tool. So what we will do today is we'll go over a couple different examples. Keep in mind, this is a tool for our mortgage professionals. We have over 300 loan officers licensed in 20 different states for primary and secondary homes. So if you want a full detailed loan estimate with all of the costs and fees, please get with our team. We'd be happy to do that. This is just our pricing tool to show the general indications of rates today. Again, it's February 17th, just after 11 a.m. So we will check out what the markets are doing with our general rates for today. So for all of our examples, we're going to set up a basic scenario, and we're going to go through a conforming conventional example for a primary home. We're going to go through the second option, which is usually FHA, is typically the second option, which we'll check out our FHA programs for the same scenario. And then we'll go into our expanded guidelines, aka non-QM programs. That's really where we specialize at the Mortgage Calculator. We have over 4,000 different loan programs under the non-QM guidelines where we can use alternative income documentation, and we'll show you what that looks like. And for the live examples today, we won't go through VA on the pricer, but Jose is actually going to do a detailed example on a couple VA quotes so you can see a full breakdown of the quotes. They have some cool things like 100% financing for purchases, which are amazing for our qualified veterans who do have a certificate of eligibility. So we won't do that on the pricer, but Jose will go in detail on that. And then same with USDA, we don't do that live on the pricer since that's only for homes in a rural area. So if you're looking at a rural area, we can quote that up in a few minutes, but since not everybody is, we won't do that today. So let's go ahead and start with the live pricing demo for today. We're going to start with our conforming conventional example. For all of our examples today, we'll do an 80% loan to value, 20% down payment. We're going to search for a desired price of 99. What that means is one discount point of buy down. Most of our clients are asking to buy down the rate slightly. So we're going to look for the best rate combination. The computer's going to look for the best rate at one discount point in cost. We're going to do a purchase, 30-year fixed, pretty standard scenario, primary, single family, one unit, state of Florida, county Miami-Dade. That's where our office is based. And for all of our demos today, we will do a 760 estimated FICO score and a 40 estimated debt to income ratio. So these are our settings that we'll do today for all of our examples. But let's check out what our conventional programs are looking like today. And let me get past the security check. All right. Well, this looks like the Home Possible and the Home Ready programs are typically the ones at the top of the list here. So those are only for our clients that qualify under our area median income. So those aren't for everybody. So let's cruise down here to a standard one just so we can compare apples to apples here that anybody could use for standard. Looks like this is the first one that pops up. Fannie Mae conforming. This is a 6.75 rate for one discount point in cost. Looks like that's probably the best option. We can go up a little bit in rate to a 6.875 for 0.875 in discount points, but those are the rates right about now. Obviously, earlier this week and last week, we saw rates were much lower. So as the markets react to these, announcements for inflation and all these other things that you guys are hearing about on the news, we're seeing the live rates fluctuate. So that's why we do the show every morning. So let's check out what would be our second example. Typically, if a customer doesn't qualify for a conforming loan, typically the next best option, we'll set up the same scenario, 80 LTV, but we're going to check out our FHA options. That usually affords us a little more leeway on the guidelines for some credit things, as well as our estimated debt to income can be higher on an FHA loan. So this is usually the second best option. So we'll keep everything else the same for our scenario, and we'll check out our FHA programs for today. And again, the markets are reacting. So this is higher than it was yesterday and, higher than it was last week. So we see our best combination here. It looks like 5.99, but I would actually go with this one, the 6% rate for 0.875 in discount points cost. And as we say every morning for FHA, keep in mind the APR over here, 6.903. Includes our monthly mortgage insurance and upfront mortgage insurance. So there are some additional fees to keep in mind on FHA. So always compare your APR so you can compare apples to apples across the programs. Now, if a customer does not quite qualify for FHA, a lot of lenders do not have other options. So fortunately, at the Mortgage Calculator, we have over 4,300 additional loan programs under our non-QM guidelines beyond just conforming an FHA, which many banks and lenders end at, right? So if a customer can't quite qualify or maybe needs a little more income to qualify, we can go to expanded guidelines and use our alternative income method. So everything else will stay the same, but you see here that we now have a new option for non-QM where our income verification can be changed. So let me scroll down so it goes down. So we always have our full doc options, which is what conventional FHA use. That's full tax returns. But then we can also do 1-year alt doc, 2-year alt doc. We can do asset related, which doesn't actually require any employment. We use assets. 12-month bank statements for business, 24-month bank statement for business. Those are very common. Our investor programs are awesome for our investment properties. And our most common non-QM program that we typically use is the personal bank statement 12-month option. So as we do every morning, we will use that for our example. And this is going to be for a self-employed borrower because oftentimes when a self-employed borrower uses their full tax returns, they don't quite make as much income as they might actually on in real life, right? So we're going to use their actual 12 bank statements to determine their actual cash situation and use that to determine a debt to income ratio rather than their tax returns. So this is typically favorable for most self-employed borrowers to use their bank statements and qualify for more house or for more loan amount and therefore get the home of their dreams where it would not otherwise be possible with a conventional program. So we love these solutions for our borrowers who need a little bit extra, and we can use these alternative income documentation methods. Now we'll see the rates are a little bit higher, but they're amazing options, again, for our borrowers who would not otherwise qualify. So the top program here for bank statements, we have a 7.75 rate for 0.625 in discount points. So that's an amazing option. We love to provide our borrowers with multiple options. So we can obviously quote conventional, and we can quote these bank statements and alternative income documentation programs side by side in case our borrowers need some extra help. Now, there are a ton of programs. If you see me scroll down here, there's dozens and dozens of different programs that allow us to use these alternative income methods. And the rates do vary on those different programs. For example, some of those programs may allow credit events such as a foreclosure or bankruptcy, and other things that would otherwise make someone not qualified for any sort of conventional FHA loan. So we love to work with these programs. Please get with our team. They can navigate which one of these fits best for your scenario and provide a solution where you may not otherwise qualify. Now, before we go into our detailed example, we always want to also check out our investment property rates. So we're going to do a couple examples for investment properties. We'll pull up the same scenario at 80 LTV, purchase, and we're going to compare our two options. We have conforming conventional options, and we have our expanded guideline non-QM options for investment properties. FHA, VA, USDA, those aren't for investment properties, so we're just going to quickly compare our two options. So if a customer does want a conforming conventional loan, use full documentation, no problem. Let's check out what the pricing is this morning. Keep in mind, the GSEs have added additional fees to these programs. So we'll see that there are no options that the computer has found for one discount point in price. So the best option the computer found for at least the lowest rate was a 7% rate for 3.25 in discount points. So Fannie Mae, Freddie Mac have added an additional loan level price adjustment to investment properties, which make it very hard to get these for one discount point. So many investors ask to go up in rate to reduce those discount points. So if we cruise down the sheet here, we'll see if we go up in rate, there's not a lot of options to really reduce it. Looks like this is a good option here, 7.49 for 2.75 in discount points. This one's a little bit higher, it's 7.5 for 2.5 in discount points, but you notice there are no options here with very low discount points. And so our investors often ask us for other options, which thankfully we have thousands of other options under our non-QM programs to purchase investment properties. So we can compare these options for our borrowers that do qualify full doc to our non-QM options. So let's check that out today. Pull this up to 80 LTV again. We're going to set this to investment property, and we're going to go to expanded guidelines. Now, there are two options that pop up under investment properties for expanded guidelines non-QM, and that is our income verification. So we're going to set that first. For investment properties, our most popular program by far is our DSCR, and that is because it actually does not require any income verification at all. We simply use the estimated rents from the property in order to determine that that property can typically cover the PITIA, the mortgage expenses of that property. And as long as it covers, we have a ton of programs, and we even have programs for a DSCR ratio under 1 where the payment or the rents don't quite cover the payments needed. So we have a ton of programs. They do vary. Please get with our team on all of these ins and outs. But let's check out some examples. The second thing we always have to set on our non-QM investment properties is a prepayment penalty. It's pretty standard for these programs. So we always price it with a 3-year prepayment penalty in our examples. We can obviously choose 0 prepay if we'd like, but that's a little more expensive. And we can choose 5-year prepay if we like to save a little bit of money. But for typical scenarios, we're always going to do 3-year for our example today. So let's check out our DSCR options for the same 20% down payment purchase. And you see some amazing options here for about 8.625 rate. We have 0.975 in discount points. So obviously our investors can now, instead of doing 2 or 3 points in cost, can get under the 1 discount point in cost. And the rate isn't that much different. So we do have our investors going with these DSCR programs often, especially because no income documentation, no employment documentation needed from our investors. And they can quickly do multiples, right? So if an investor has 5 properties, we can refinance a couple, so they can then purchase a couple, and we can do all the loans at the same time because they're not employment-based loans. They're all just based on the property. So our investors love these programs. Typically, we'll do a couple DSCR loans at a time for most investors, and they love these things. So we have a ton of programs you'll see here that vary in rate and cost and whatnot, and that is because, again, with these non-QM programs, there are thousands of them. Each one is unique. So please get with our team. They'll navigate the one that may fit best for you. Some of the ones you see at the higher rate and cost combinations are likely maybe they allow short-term rental income, or maybe they allow a DSCR ratio under 1 and some other things. So please get with our team. They'll find the program that fits best for you, but we absolutely love these programs. So now that we've gone through our programs, let me go into our deep dive example with Jose. And let me really quick just introduce the topic, and we will get into it. All right. So again, today we're going to go into a deep dive topic as we do every day, and this topic is going to be on VA loans. So for our veterans that do have a certificate of eligibility and do qualify for a VA loan, we would love to assist you. And there are a ton of options within VA that are very special programs. So we love to work with our veterans. We don't do this live on the show every morning because they are pretty specific programs, and only veterans that do qualify can access those programs. So I'd like Jose to talk a little bit more about the couple different options that the VA eligible borrowers do have, and then go into a deep dive on an actual detailed quote. So I'll go ahead and pass it over to you, Jose. Jose, our sales manager, 27 years of experience, has worked with a ton of VA borrowers. So go ahead and take it over, Jose.
Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. VA loans are definitely one that is very important to us, not because of the production of a new loan, but because of the assistance that it provides to our veterans and active service members. We do definitely appreciate them because it is their service that keeps most of us from having to do what they do, right? They put up their lives up to protect ours. So thank you so much, veterans and active service members. So VA offers very interesting options, including 100% financing and of a purchase, and also 100% financing of a refi. Two very important factors because 100% financing is typically limited, and the only other scenario is with USDA financing for a purchase or for a refi. So, and those are based on location of the property, whereas VA is strictly based on if the borrower is eligible because of either current service in the military or because they are a veteran. So some of the important points to note on the VA loan is, most importantly, VA loans are not subject to mortgage insurance. Very important and interesting point there. However, there is a funding fee which needs to be taken into consideration, which is their version, I guess, of factoring in mortgage insurance into the whole mix. They call it a funding fee. It can be anywhere starting at 2.3% as high as 3.6%. However, and that's going to be based on if it's a current use, subsequent use, if they've had their entitlement restored, different things that you would know when you're viewing the certificate of eligibility, which is what's needed in order to see exactly the details under which the veteran qualifies for the program.
And the disabled vets do have a little bit of extra benefit there. Disabled veterans do save on that funding fee, by the way. So make sure for our loan officers, if you're looking at that certificate, make sure to look if they are disabled. They do afford some extra benefits. Sorry to interrupt you there.
If the veteran has at least, or he could be actually still active duty. So I keep saying veteran, but if the borrower has at least a 10% service-related disability, then the funding fee can be waived. They would be exempt from the funding fee. So in the example that I have used here, I have included the funding fee on the three examples. So funding fee, no MI, active or veteran. Now, also on the VA loan, something to note is co-borrowers. right? A co-borrower and borrower in a VA loan need to be legally married. Whatever legally married is considered in your state, they have to be that, right? Um, it cannot be that they're just living together forever, brother and sister, father and mother. Those combinations are not accepted. They have to be legally married. In some circumstances, the VA may grant an exception if it is like, father, daughter, son, brother, sister, something like that. They may grant the exception, but on those cases, prior authorization needs to be obtained from the VA directly to be able to include anyone in the loan that is not a spouse of the borrower. Now, you can have a spouse of a deceased service member qualify for VA benefits because they were married, service member died, they now get those benefits transferred to them as their surviving spouse so they can use the VA benefits. So please note when you are structuring your files, take these factors into consideration, especially if you're looking to add co-borrowers in the way we usually add them. Please take these factors into consideration and follow the proper procedures to try to get that exception before the file is submitted to underwriting. So in the first example that I have here, I'm going to jump right into it and probably show you what could be one of the best options for the VA refinance is known as the Earl refinance. This will allow you to go up to 100% LTV, finance the funding fee, so you're actually going to have greater than 100% LTV. But the real important thing to note about the Earl, now this is when you're going VA to VA. So an Earl would be a refinance of an existing VA loan, right? So due to the fact that they know it's an existing VA loan, right? You probably will not have to order an appraisal for that property. You will not need a new certificate of eligibility. You will not have to verify any credit. You will not have to verify income, nor will you have to verify employment. I mean, it's a pretty easy loan as long as upfront the loan qualifies due to the requirements to even be an Earl, which is very basic, existing VA loan, right? So this is for refis only, and not a cash out option either. This is rate and term refinance at this LTV, but very streamlined options because if the borrower was having credit issues, was having job issues, property valuation issues, whatever issues you think there may be, the Earl will allow you to overcome those obstacles. So in the scenario here, we have actually 6.99 is actually giving us a little bit of a lender credit, and 6.25 is charging a little bit there. It's the lowest cost option in this example. My loan amount is $500,000. So that's a little bit, probably a little bit more than an eighth there that they're charging in cost. And then the lowest rate at the highest cost is 5.75% rate at a cost of 2 points. Right, so this is the Earl. This is super streamlined option here. No credit requirement, no appraisal requirement, no income requirement, no job verification requirement. Just has to be a refi of an existing VA loan. So now we go into a cash out option. Now this is just going to be not an Earl, regular VA loan, 90% loan to value on the cash out option. Theoretically, VA goes up to 100%, but basically most of the investors are adding an overlay to the VA guidelines so that they're pretty much capping the cash out refi at 90%. An overlay is not a guideline change. It's just an additional condition that investor is putting on the loans that they want to accept, the loans that they want in their portfolio or their package of loans that they need to sell down the road. So those that put overlays is because they usually want a stronger package, right? Whereas VA allows 100%, they're telling you we'll take 90% on the cash out. So the Earl also does offer, obviously it's not cash out, but the Earl also does offer a little bit of preferred pricing and preferred costs on the Earl. So on the regular cash out, you'll see here it's a little bit over 1 point on the lowest cost option, and the lowest rate, 6.25, is just a little bit under 2 points in the fee. So this is 90% cash out refi. So now we go to what everyone knows about the VA is the 100% purchase. So we go back over here, and again, we have some really great rates. You have lender credit at 6.75 of about 0.4, lender credit at 6.625, and actually the first rate at which there is any type of a loan discount is 6.5% with an eighth of a point in cost. Going down to as low as 5.625% interest rate with a cost just under 2 points. So again, very good rates. You'll note that the rates on VA appear to be a little bit lower than the rates on the conventional loans, probably having to do with the funding fee that is sort of like a type of mortgage insurance that comes into play there and gives the additional assurances of the United States government, right? So definitely good option here with the VA loan at 100%. So remember, 100% finance is possible on a purchase, 100% finance is possible on an Earl rate and term refinance, and 90% LTV is possible on a cash out refi. So looking forward to helping you all structure your VA loans.
Thank you, sir. So let me go ahead and pass it over to Kyle, who can explain how to get a full detailed quote like Jose was just showing everybody. That is the full detailed quote and has all of the details and costs and all that kind of great stuff. So go ahead and take it away, Kyle.
Yeah, absolutely. Thank you. So if you are already working with one of our loan officers, maybe they shared this video with you, go ahead and reach out to them and they can get you some of these quotes instantly like Jose just went over. They can get you those within a few minutes of your actual scenario and actual costs and all that kind of good stuff. If you're not working with one of our loan officers, then go ahead and visit us at themortgagecalculator.com and we will connect you with one of our loan officers. We have over 360 loan officers. We are licensed in 20 states and we can do business purpose loans and commercial loans and those types of things in most states as well. So, as Jose showed, a few different routes that you can go with VA. Also, as Nick showed earlier, a few different routes you can go. Well, really many different routes you can go for non-QM leads, the non-QM programs like the bank statement ones that he showed, like the DSCR quotes, all that kind of good stuff. So lots of different options here that we have to bring to the table, and our loan officers can consult you through that process. So whatever it is that you're looking to do, the loan officers here at the Mortgage Calculator are trained to be a consultant and be able to walk you through these thousands of programs that are available and help you find what works best for your situation. Most lenders or investors only have, different conventional FHA, VA, USDA, but we obviously go above and beyond that and are trained to help our clients in whatever they need. So we do this show every weekday at 11 a.m. Eastern. We go through the rates like we just went through today. So you can kind of see the up and down of the rates as they go when you tune in daily. And we do a deep dive each day into a subject like this, just like we did with VA loans today. And sometimes we'll do them with investment properties or we'll do them with different things. So definitely tune in every weekday at 11 a.m. Eastern time. Thank you, everybody, for tuning in. Everybody have a great weekend, and we hope to see you next week.
Thanks, everybody. Have a great weekend.
Thanks for tuning in.